Hello everyone and welcome to Financial Accounting. Today we're going to look at collectibility and how it affects revenue recognition. When we talk about revenue recognition, it is important to keep credit risk in mind. Credit risk is the risk that a customer will not be able to pay in accordance with the contract. If the contract exists and it's probable that customer will pay, whether a company will get paid is not a consideration in determining revenue recognition. When assessing collectibility, a company should determine whether the customer has both the financial capacity and the intention to pay the consideration owed. It should consider all relevant facts and circumstances, such as the customer's credit risk and credit history, as well as current economic condition of the customer's industry. Note that one requirement for recognizing revenue is that collectibility is probable. Topic 606 of the Accounting Standards Codification, often referred to as ASC 606 or FASB ASC 606, requires that entities determine collectibility as part of step 1 in the revenue recognition process when assessing whether a contract exists. You can learn more about the 5-step approach in my video, Revenue Recognition, and the 5-step approach. The link is posted here and in the description. ASC 606 is the topic of the Accounting Standards Codification that establishes rules for recognizing revenue in contracts with customers. The Accounting Standards Codification is the complete and official version of the Generally Accepted Accounting Principles, GAAP, published by the Financial Accounting Standards Board, FASB, and used by various entities in the United States. If you would like to learn more about FASB codification and how to use it, I am posting the link to the FASB codification video here and in the description to this video. Note that while US GAAP and IFRS both use the word probable, there are some differences in its definition between the two frameworks. Probable is defined in US GAAP as likely to occur, which is generally considered a 75% threshold. IFRS defines probable as more likely than not, which is greater than 50%. If collectibility is probable, we don't need to adjust the amount recognized as revenue for customer credit risk. Instead, companies use the allowance for bad debts, a contra asset account to accounts receivable, to account for estimated bad debts. Accounts receivable, net of the allowance for bad debts, is presented on the balance sheet. If you are interested in learning more about accounts receivable and allowance for doubtful accounts, the link is posted here and in the description to this video. Now let's look at an example of collectibility. In December, Delta Corporation sold office furniture to several customers for $100,000. Delta Corporation believes that control of the furniture has transferred to its customers. In addition, Delta Corporation concludes that collection from its customers is probable. Based on historical trends, approximately 2% of the receivables will not be collectible. How much revenue should Delta Corporation recognize in December? Since control of the furniture has transferred to its customers and collection from the customers is considered probable, Delta Corporation should recognize $100,000 in revenue without consideration of the credit risk. It should present an allowance for doubtful accounts or bad debts, recognized initially and subsequently in accordance with respective bad debt guidance, as we discussed in the video Accounts Receivable and Allowance for Bad Debts. The estimated amount of bad debts is reported as an operating expense in the income statement. I hope you found this video helpful. If you did, please make sure to subscribe, hit that like button and ring the notification bell so you are notified when we release more videos like this. Visit my channel for more videos on financial and intermediate accounting. Thank you all so much for watching, and I hope to see you all again in the next video.